Okay, so as I was saying, assets are equal to equity plus liability, meaning that we have all the assets that have value, things like land, things like equipment, right? Physical capital. But not only things that have positive value, but also debts and things that have negative value. So we haven't talked about equity quite yet. We'll talk about that in a minute. And the liability is a term that we just looked at. So, okay, now that we've talked about these terms, let's look at the tasks of a financial system. So there's three major tasks that a financial system is charged with. Reducing transaction costs, meaning making sure that costs are cheap and efficient when executing deals. Reducing risk, because investors don't want to take on high levels of risk when they invest or when they trade. And then finally, providing liquidity. To make something liquid means to make it as close to cash as possible. The most liquid asset is cash itself. Why do we call it liquid? Because cash can be easily moved around from A to B to C, whereas a different asset like land is very difficult to exchange, difficult to swap. It's not a liquid asset. There are four types of financial assets that we're going to talk about. Loans, bonds, loan-backed securities, and stocks. You can also find these in the textbook. Loans are a general agreement between a lender and a borrower to repay some money over a period of time. Bonds are a type of loan where we have a principal amount and interest. We'll get into detail on that in a minute. Loan-backed securities represent the combination and pooling of all these individual loans, and they're all put together in the same place. And then stocks are not liabilities. Stocks are ownership. Stocks represent ownership in a company. Okay. Okay, we've got two different things that we're looking at here then, right? We have liability and we have equity down here for stocks. So we can look at we can look at the equity markets, and we do call bonds as being part of the equity markets because they're a form of investment. But when we look at them in terms of accounting, we look at them as liabilities because this is related to a specific company, whereas when we're looking at equity markets, we're looking at general investment practices from various consumers. Here we have a picture of the bull in New York. This represents the stock market. If we have a bullish market, it means that the stock market's performing well. If we have a bearish market, the market is performing poorly. So this is a fun way of showing that in New York, there's always a bull market. Everything's always going well in New York. Bonds. Okay, so the yield on a bond means how much, what the percentage rate is that is getting paid out relative to the principal of the bond. Okay, so we can calculate that by looking at the interest payment and the bond price. Excuse me. So we can think of it like this. Bond price equals interest payment divided by yield. So if we had a bond that paid out $50 and the yield was 8%, then we would know that by plugging in those numbers, we're going to get a $625 bond price. This looks really related to what we were talking about in terms of general loans, right? Because a bond is a type of loan. Okay, let's take a look at how businesses finance themselves when they first get started or if they need external financing. Those of you in my management class will already be familiar with this. Let's say we have a lemonade stand. We have a kid who wants to sell some lemonade, but he doesn't have the money to pay for his costs for his lemonade, right? So how does he get this money? Because he doesn't have revenue yet. He has two options. He can do equity financing or he can do debt financing. Remember, debt like liability. So let's take a look at if he chose to start this lemonade stand with debt financing. So he goes to his grandma, says, "Grandma, can you give me $100? I'll pay you back the 100 plus I'll give you interest." Okay. Grandma says, "Okay." And she decides to buy a bond, right? She decides to loan the money. Bonds are types of loans or IOUs. Remember IOU, I owe you money. That's just a fun way of writing it. That represents debt. And in this example, we have simple person to person, but governments also have bonds and corporations also have bonds, okay? The bond holder does not have ownership of the company, but they do have legal right to recoup their money. An interesting thing is that if a company goes bankrupt and they're unable to pay both their bondholders and their stockholders, bondholders get paid first. So that's one good reason to be a bondholder. Okay, but let's say after this debt financing, we still need to raise more money for our costs. So another option is equity financing, right? So you can look to your brother Tom. You can sell him some shares for $50, right? So you can say, all right, I've got 100 total shares, and I'll sell you 50 of them for $50. So $1 per share, right? So it looks like Tom bought 50% of the business, and these shares represent dollar values of real dollar values, and it represents the value of the company over time. Right now, it's one share represents $1, for instance. Okay. If you ever become a shareholder, then that means you're entitled to a percentage of profits because you can sell off your shares at any time, and you can profit in that way. Stockholders can earn profit in one of two ways. They can do it through dividend payments, which are a percentage payout of total profits. These are paid out to stockholders from corporations. Corporations can choose whether to pay dividends or not. Not all companies do. And then there's also what I just mentioned, which are capital gains and capital losses. A capital gain is when a stock gains value over time, so it increases from $1 to $2. And a capital loss would be if we lost, if the value of the stock went from $1 to like 50 cents. Okay. Let me make sure that I'm still able to record. And it's okay. Everything's going good. Okay. So stock certificates, they used to be like physical certificates that you'd get issued, but nowadays they can just be done online. But you can think of stock certificates as looking just like this. They indicate ownership. Okay, what are some problems that that borrowers and lenders face? They face issues related to costs, related to risk, and related to need for liquidity, which is related to what we just saw before, that financial markets, or that the government's trying to kind of help out with, right? The three things that borrowers and lenders are worried about too. We got to also remember that time is very important. So when we look at investments, we got to know that the longer some bond has in terms of when it needs to be repaid, that's going to take a totally serious impact on both the lender and the borrower.